2, 1. All right. If somebody on the screen who's listening, can you give me an audio check? Somebody within the audience. Audio check.
We're not live.
Yeah, we are. I've got 2 viewers. Is it not showing that we're live?
No.
Refresh.
Yeah, I just process me. Hang on.
Okay, we got chat.
Yeah, we got.
Good morning. We can hear you. All right. Let me do this. All right. So, good morning, good morning, good morning. All right. So, today we got a special guest on, and I'll introduce him after we get to a certain part of this. Morning, Andreas. Good morning, Matt. Good morning, Sam Kong. Hey, Sam, you're new. Cool. All right. So, let's start the process. And then right now, what we're going to do is I'll go through our measure of momentum through the higher time frame and where we are. And then I'll introduce our guest. He'll start talking about his process, and we'll discuss like why what he does is very important in relationship to what I do. And then while he's talking and going through his system, I'll be in the background building the highest probable statistical levels for the day. So we have them, and yeah, it should be fun. All right, so looking at the daily chart, we're above previous month 50%, which is right here, and NFP Friday, right? We closed, good morning, Andy. We closed above NFP Friday on Tuesday, and we have not been able to come back into it, period. Oh, I guess we did on Wednesday, but that was doing London. And so now it's Friday, and let's go to the weekly chart. Remember, based off of NFP Friday, and this is confusing for some people because they haven't been with us long enough to understand the system, right? But NFP Friday in previous month 50%, right? All these yellow boxes are NFP Fridays, and the blue lines are the previous month 50%, right? This is telling us, right, where the momentum is going, right? From a live tape reading exercise, right? It's the first Friday of the month, and there's a reason I chose that Friday. That's irrelevant. Go back test it. You'll probably see it. But basically, once we're above previous month 50% and the NFP Friday, we can anticipate closing the month higher. If we're below on both, we can anticipate closing below the month lower, right? And what this allows us to do, the relationship with price, NFP Friday, and then previous month 50%, right? When we start, like in this case, right here, when we start swiping back into it, it starts giving you indications and clues of either what style of pullback you can expect. Are we going to expect a monthly pullback? Or we expect a quarterly pullback? Or are we actually shifting from, like those healthy pullbacks that are expected in a month, right, for the closing price of the month? Or are we actually, turning over into something bigger than a monthly or quarterly pullback, right? So real quick, let's do an exercise. This is NFP Friday. This is previous month 50%. We started a bullish trend on November 2nd, right? Then we got above NFP Friday right there. Closed the month higher, right? This month we couldn't reach down to this previous month 50%. We stepped above NFP Friday. We expect to close the month higher. When you see unfilled gaps within this transition, that's a huge sign of strength, right? So when this is pulling back on the daily chart, we're looking to see if the daily can close below previous month 50%, just like we're looking to see if the daily can close above NFP Friday. Once that happens, we anticipate the month closing higher, right? We start swiping back in NFP. We can't get below previous month 50% right here. Let me do my little arrow thing. Oh, I never can find the damn arrow. There we go. Right? We can't get, now that arrow's obnoxious. Do this arrow. Right? So this month we open up, we have a monthly slowdown. Can't get below previous month 50%. Start closing above NFP Friday on the daily, but here's the thing. We start swiping back into NFP Friday. Right? We still anticipate that we close the month higher. However, this is a sign of slowdown and weakness to me, right? Why? Because this is letting me think, hey, listen, number one, in a strong market, we usually close the day higher than we open the day, right? Doesn't mean that we won't have days where we doji or we close lower, but for majority of the month, we're closing higher at 16.15 when the market closes, and we are, closing lower, right? So when you start seeing this, now you can start anticipating, all right, now we're getting into a more mixed market, right? But we still anticipate closing the month higher because we can't get below NFP Friday and we can't get below previous month 50%. On this month, we can't get below previous month 50%. We close above NFP Friday. We anticipate for a higher close, but now we're really digging deeper into that NFP range, right? And you can see the relationship between green versus black candles, right? Closing higher versus closing lower, right? All right, so this is giving us huge warnings for the next month to pay attention, right? This month opens and immediately we close below the previous month 50%. We still have to wait for NFP Friday, and then NFP Friday comes, we close below it. What do? We know this is going to be more than a monthly slowdown. Like these are all monthly slowdowns, and we look at what those look like on the weekly chart. But now we're anticipating a quarterly slowdown, right? So the first thing we do is look for quarterly lows. That quarterly low was right in this area. When we get to it, we start a new month. We recover from it and start a new month. And on NFP Friday, we get above previous month 50%. And we also get above NFP Friday. And then we start the cycle all over again, right? So, and we're going to speed this up. We can't close below previous month 50%. NFP Friday, on daily chart, we close. We expect to close the month higher, right? This one, we close below NFP Friday on this day, and we'll wait in to see before we start really getting serious with everything, with looking for a quarterly pullback, because this pullback did not happen as a monthly pullback, right? Because the week of the month that it happened, and the fact that we were so quick to close below NFP Friday, right? We closed below the previous month 50% right here. We expect quarterly lows. Well, quarterly lows are down in here. We go to it by a couple ticks, and then we recover from it, right? New month, we're above NFP Friday, but we're below previous month 50%. So we're in limbo land. So one of the things that we use the system for is to determine, are we looking for the low of the day or the high of the day based off of this between 5 o'clock and 11, right? When we're in limbo land like this, where we're stuck between the two, NFP Friday and previous month 50%, right? You got to look for both, right? During these easy markets, we know that we're looking for the low of the day. These wicks are happening between 5 o'clock and 11 o'clock in the morning. We expect to close higher. During this time, and I told you guys, like, you got to look for both sides of the market, right? This is the great unknown, right? This NFP Friday, right? We open up, we go higher, we close above on September 11th. NFP Friday, and we're above NFP or previous month 50%. It just happens that they all align like that. But our system is no different, right? We have to wait. I mean, we expect to close the month higher, right? Now this month, and I'll walk you guys through it, we opened above previous month 50%, and we had daily closes above NFP Friday, so we expect to close the month higher, right? So when we come over here, like we have this is the weekly chart. We have a 5 EMA on here. That 5 EMA does nothing but act as a constant variable. So these are a representation of weekly closes and distances between that 5 EMA and the weekly close, right? The measurement of them are the variance, so the distance between them. This is just as an example of what we're doing, right? So you can see during that whole walkthrough, like we can expect we'll get in between 2.5% and 5%. We expect monthly slowdowns, right? That's happening in relationship to this NFP Friday. If you start listening to the news or start looking at the market regiments that Andreas uses, you'll see that doom and gloom starts coming across your speakers on Bloomberg. You'll see that like you're starting to show signs of weakness on the industry and sub-industry groups. You'll see that everybody's out there trying to fool everybody to grab their growth products, and it's just a rebalancing act for large portfolios, right? So we slow down. NFP Friday happens on right here on this week. Week 3, we get 3.89%. Week 4 and week 1, we do that monthly slowdown, right? This month, week 3, we get 3.4%. We do that monthly slowdown. This week 3 into 4, right? We get 3.16, and then we do that monthly slowdown, and then we ultimately do that quarterly low, which we saw, and then we rinse and repeat, right? We go up for week 3, we get 3.5%. Week 4 and week 1, we do that monthly slowdown, and then we in the higher, and then this one we get 4.53% extended, and then we do our quarterly pullback and such and such and such, right? So we are in a bullish trend right now. And the exercise that I like to have you guys do is this exercise, why this is important, because I want you to listen to your favorite economists. I want you to listen to Bloomberg. I want you to listen to, the freaking gurus and furus out there. And I want you to hear their tones during these monthly slowdowns. Like everybody and their mother is trying to convince you that the market's going to freaking crash and burn and you should hedge your portfolios. And that's really what it's about, the hedge, right? These like third weeks of the month are, I don't know why it happens this way, but they try to convince like hell that you should put on hedges, right? Because hedges, like there's a lot of liquidity and money in hedging portfolios, right? And they make a killing off of people hedging. And for the portfolio manager or for the trader, hedging is a very expensive game, especially if you don't know what you're doing. And that's kind of like how me and my buddy Andreas, who's on the show right now, this is how we met, right? We met because, like we were trying to figure out, these different economic clues and stuff like that to manage our portfolios. And then we realized, like, not that they were full of shit, but an economist isn't really good for a trader because the economist is good for collecting data and looking for that secular or that cyclical trend, right? So they're always forward looking 12 to 18 months out, right? Anything economically takes forever to factor in pricing in the markets, right? And so like last year was a great example, and the year before that, me and Andreas can talk about, right? Everybody and their mother was telling us the market was going to crash and burn because of a recession. Meanwhile, we had probably this last year was one of our best performing years year to date because we had to say, hey, guess what? They're cool and all, but like they're running subscriptions, they're running their own clients who don't have the same time horizon that we have, right? When it comes to placing a trade, they're looking to get in these markets anywhere and stay in position between 18 months and 5 years per position. So like we were not synchronized with the right information with the style and the time horizon that we were trading. So we've spent the last 3 years building systems that we could actually trade off of. And that's when I'll hand it over to you, Andreas, and let you show your chart as well.
Thank you. Let me just get my screen up here.
And while he's doing that, why he's on here is because it's very good for you guys. Good morning, Zusi. It's very good for you guys to know that your life savings cannot go into an intraday, right? It's not smart, regardless, to regardless how you think, how great you think you are on these intraday trading charts, right? Like it's not physically, it's not responsible, right? To have all your life savings of you, a hardworking individual, a working class individual, throwing all your life savings in the intraday trading space, right? You have to, you need to diversify, right? So for me, the way I manage my money, right? Number one, I budget. I pay off all my credit cards, which have interest rates, right? That's more important than any kind of investment that I can do on these charts because that's risk-free yield that's coming back to me. So first and foremost, you need to get your budget in line. You need to get your debt in line, like pay those high interest rate debts that you have off, and then come into the markets. And when you build a portfolio, right? Like the way I do it is like I like having a cyclical part of my portfolio, which is usually my 401k, which is 5% match, right? That's another 5% of risk-free return, right? And that's aligned with that cyclical trend from 12 months to 18 months out, right? Like I'm making plays on that based off of where we are in the growth and inflation, based off of where the interest rate cycle we're on, and then 20 to 30% is doing what Andreas does, and then only 5 to 10% of my wealth goes into intraday trading, right? Because that intraday trading requires the most babysitting of my cash flow, and it requires me to bare knuckle fist fight with the markets, but it produces the largest return, right? Which allows the other parts of my assets to be hedged or to add alpha without coming out of my paycheck, which is huge, right? So with that being said, Andreas, let me share your screen, and I'll let you hand it off. And right now, before he gets into this, like the screen, the chart that he's sharing, there's two types of liquidity out there. There's market liquidity, which a lot of you intraday traders understand. You know whether the market's liquid or illiquid. You know what an imbalance. You know what market liquidity generally looks like. What he's talking about when he talks about liquidity is funding liquidity. The difference between the two is market liquidity is for markets. Funding liquidity is for economies. All right, and that, with that being said, Andreas?
Yes, perfect. And let me just refer that I really like your work, and what I most use is basically the mid-month and the NFP Friday. So I'm a positions trader, and I hold positions. I don't know, from 10 days to 3 months or something like that. So I really use your work to underpin my analysis, and your work is the only work I'm I'm using. I don't use any other subscriptions or because we built our own frameworks, and I really trust your process.
Same with
So
you.
yeah. So what I'm doing, the first thing in the evening or in the morning, I look at the GEX. It's basically measurement of gamma of call open interest and gamma of put open interest. So it's a kind of a sophisticated put call ratio, and I have access to that. I didn't write a program. I did it, by hand. But what I basically saw is that, especially at the bottoms, it can give very good signals. For example, here, market is down, GEX is up. That's something where I'm interested. Same thing here. I warned in my blog. I was getting hedgy, getting into hedges here. When it makes lower lows, it goes to extreme, goes to lower low. So I like to see whether we are in a positive gamma or negative gamma environment, and that's kind of my first step in the process. So, for example, I think I put on a hedge somewhere here. Then I saw that I lifted the hedge because this and everything else looked good. So it's basically a look for divergence. So price up a little bit and GEX up a lot is good, and the other way around. So that's kind of my first step.
And then one thing I'll inject into this, so for you ICT traders, right, you guys look for those SMT divergencies between ES and YM or NQ and ES, or, in today's market regimen, it should be your indices with crude oil or your indices with a 30-year yield, those are where you should be focusing your divergency efforts on. But this is another resource that you can use to, find divergencies with, because it's very telling.
Yeah, basically, my quads, for example, November, your NFP Friday and mid-month turned bullish in November last year. I think on the 2nd November, I was bullish on the 3rd November, and I basically saw a lot of options trader who were also bullish on the, basically first November. I tried to find out how they do that, so I digged into that, and so that's part of the process now.
Yeah.
So the second thing I look at my trading systems in portfolio 1, 2, 3, and I look at growthy systems. So systems that are basically based on a growth ranking system. So that's everything. That system uses that ranking system here, and that's everything about growth. And when growth is doing well, I basically know that we're in a positive environment. And I trade a lot of pros, so I want to see that. So this is the system 1 year back on the cubes, on the universes, the cubes 100. So that looks fine, right? And I reran it this morning. It popped yesterday. That looks perfectly fine. I don't have any reason to be bearish right now. Basically the same with the GEX, looks fine too. Second thing is I look the same system just on the S&P 500. Also looks good.
Will you walk, because I know I'm probably the only viewer who actually understands portfolio 1, 2, 3. Will you give them a quick brief summary of what this is and what it backtests and how it uses the data to tell you where you're at?
Yeah. Well, portfolio 1, 2, 3 is basically they have a point in time database, which means they have very, very clean data, and you can test everything you want. And I do some consultancy work as well, people shooting off basically ideas, and you can implement the ideas very fast. Just whatever, last week I had this screen, right? So you can screen, you can build portfolios. I took a screen from my network in the breakout, Ken Slim traders, and I took their screen and just back tested it, right? So you can, every idea you can back test, and the idea was to see, okay, is their screen, has the screen they're using a positive expectancy in the first place? And I was very happy to see that this is the case, right? So you can basically put the stuff in here and then run the back test, and it's very fast, and every idea can back test pretty good. So what I'm doing basically, for example, for my breakout trading, I have that screen, put it then to TC2000, filter it out a little bit more, and I want to use stocks in my breakout trading that have a good expectancy in the first place, and then I put my technical analysis on it in order to use it. But the first step is always the market, right? I want to see if the market is doing well. For that, I build systems that are growthy. When growth is doing well, I know the market is in good shape. And that's what I'm basically doing here, right? This is the whole back test. And then I can put it to a book, and then I can see whatever. I can say, okay, show me the last, because this is not, sorry, this is not looking very, I'm sorry. If you don't see much here, right? I mean, you just see it has a whole lot of beta. That's what you would expect from a growthy system, but you don't see very much. So that's the reason why I put it into a book, and then see that system. Whatever, something like last year was pretty interesting as well. 1 year, go back, and I see basically relative strength of growth. And that's what I'm looking for. So same thing here, again, same system on the S&P 500. Looks perfect, right? I mean, so that tells me that the tech space is a little bit weaker, but there are other growthy areas that are doing fine. And especially what I really love right now is that mid caps. This is the Russell 3000. I mean, they're just printing all-time highs. So so that's the second step. What I'm basically doing to see where the market is. And the third step, I look at network momentum. For that, I put everything that is growthy into in a bucket. So, for example, I call that quad one and two. This is quad one. This is quad two. This is quad three. This is quad four. Quad one is everything growthy with some signals in there.
And so real quick, let me,
Yeah.
because I know my viewers are probably confused right now, but what he's talking about with these different quads are the different market regiments that the growth, inflation, and interest rates are like, right? So, like, for example, right, you know, a Goldilocks period is when growth is going up and inflation is going down, right? And interest rates are being cut, right? Inflationary period is when growth is declining, but inflation is going up and interest rates are usually flat. A recessionary, right, or stagflation, whatever we want to call it. What is the things that Darius they'll always calls them? I'll let you go through that. But basically, what he's doing is he's taking all the industry groups. Remember, the QQQ is built off of industry groups, right? And he's aligned them where these industry and sub-industry groups will tell him, what market regiment the actual industry groups, which each industry group has hundreds of companies and underneath of them, right? Which ones are outperforming the market, right? So it tells him what style of market regiment, growth, inflation, and, interest rates, like which ones are outperforming, because that allows him to front run and forward see like what the market is truly pricing in versus what the economist does, which they they wait on, Fed data and economic data, which is always being revised and always being twisted. So you might hear some of the more professional people say that the market's pricing this in and the market's pricing that in. Well, this is truly looking at what the market is truly pricing in. And I'll let you take it over.
Yeah, that's basically the idea. Remember when we basically met, we looked at a lot of macro data, and we basically find out the only thing you can look at is liquidity. So stuff like Lynn Allen is doing, or cross-border capital. But then you still have to see where's the strength, right? I mean, even if you're bullish, you want to be in the strongest areas of the market, and that's what I'm basically trying to do. So everything cyclical and growthy is in here. Everything growthy is in here. Everything that profits from inflation. So when the market is pricing in inflation, those things will be bullish trend. And if it prices in deflation, those things will be bullish trend. So I used to do automatically, but right now I do it by hand. So basically you want to see, I always look at the cubes first. I want to see relative strength. So that red line is relative strength. The yellow line is basically the 5-day moving average of relative strength. And what I basically see is want to see the red line above the yellow line. That's the case right now. So the cubes are looking bullish, and everything that is flagged here is bullish trend. And then I just count, really, really simple. If I have more exposures in the quad 1 and quad 2 bucket, they're bullish. I know the market is growthy and the market is in good place. If I, see something like oil and I don't have much bullish trend here, I know the market is pricing in inflation. So, let's just say this would be all bullish trend, then I would know it's quad 3, which is inflationary. So I have to concentrate. I might want to hedge because that gives a lot of backfills. Then I would go basically to your analysis and see also, okay, where's mid-month, where's NFP Friday, and if this all is bullish trend, then I know we're in a quad 4, and I really have to be careful. So that is
why that's important, right? So like there's times that my system, like we talked about my system, like all last month we were in between NFP Friday and previous month 50%, and I was very confused. right? Like, and I reached out to him. I said, listen, like, I'm not seeing the market clear right now. It could go either way. And he actually was like, hey, no, like, listen, like, the stocks are performing. What's underneath the hood of the NQ is performing right now. And that, like, led me to, being able to see the markets, right? And then there's times where his systems are, like, foggy and, iffy. And then he'll reach out to me. He's like, hey, do I need to be hedged right now? And I'm like, no, like, absolutely not.
Yeah.
This is what I'm seeing. So we counterbalance each other out very well. What I'm not covering, he's covering. What he's covering, what he's not covering, I'm covering. He focuses on under the hood, and I focus on the body of the car.
Yeah. And one last thing I want to show, I also back tested, my bullish trend criteria. So if you go, for example, let me just see here. Select date on chart. So for example, around here, the GAX didn't look too hot anymore. And, that was still quad 1 to 2, but then basically, right, you see it like turns over, quad 3 is coming up. And then basically that day gave pretty good warning, or at least that day gave pretty good warning that, things are not doing that hot anymore because quad 3 and quad 4 is basically coming up. And I went back to 1999, testing week by week, and it's not, obviously it's a trend following system, and it will give you wrong hits. And but something like November last year, I was basically bullish here and catch the big trend, and that's kind of the good idea. And also remember, I'm still long, right? Even a situation where I see a quad 3 and 4, I try to hedge the portfolio and lift the hedge on the right moment. So that's what I'm doing. And again, your work is absolutely fundamental to my stuff. I always look at mid-month and NFP Friday to see, basically you have an overlay to my analysis. So that's it.
Yeah, absolutely. And can you go into like what you found with fund and liquidity and how that supports your systems as well?
Yeah, basically, I mean, we really stretched our head. I mean, 2023 was really, we saw in the group, you and I, we saw actually a bullish tape, and every economist was like, calling for a recession. We did say screw that, and worked with network momentum. So what is the market pricing in? Price pays, everything else is just a derivative. And I think the market is very smart to front run those economic things. And the only thing out of the macro space that I'm still looking at is liquidity. So I'm looking at cross-border capital, and Lynn Allen is doing that as well. So basically, are the central banks providing liquidity? That's not just interest rates. They have other instruments too. And, they have correlation studies where they basically say something like, the growth space of the market, Bitcoin, something like gold has a very big correlation to that liquidity. That's the only thing I look at, though I still use my analyze first. So when cross-border capital, for example, says, okay, we're they were bullish exactly at the bottom. I think it was October, November 2022, where they say, okay, the liquidity changes and that's going to hit the market. You still had pretty big drawdowns in 2023, right? From August to November, and they can be pretty steep. So I use that liquidity measure to understand, okay, we're generally in a bullish year. And if I see a quad 1 press, quad 1 or quad 2, so I see growthy stuff outperforming than press, and where I would be a little bit more careful if liquidity would be down, and I would see a quad 1 to 2, but that's just an overlay. I mean, Michael Howell also basically says that you have to still see the network momentum in order to see where strength and so, yeah, basically your stuff my stuff is, I don't know, 95%, and that's just an overlay that's left from the macro space. And the other thing, those guys also say everything else is secondary. Liquidity drives everything, and you have to see the network momentum, and almost every other indicator, economic indicator, like GDP, inflation, is not leading the market. It's the other way around. I know that, a lot of people will hate me now, all those macro guys, but it's just not the case. I mean,
Well, I
and
think
it makes sense. If liquidity is up, what happens?
exactly.
What happens? It flows to the market. If liquidity is there, and that liquidity has to go somewhere, and it flows at the same time, it flows to the economy. But until a CEO bought a new whatever production line or something like it, it will take time until it shows up. But the market takes the liquidity right away and reacts.
Exactly. And that's the thing is like you as a trader, and this is why you'll see more traders build their own systems than go the historical way, because as like the working class has realized that like I don't want to pay a 15% margin rate on a financial advisor managing my capital. You'll see a lot more like this is the generation of working class individuals saying, I'm going to manage my own portfolio because I don't trust the big bank. That's a result of, the dot-com bubble, them watching their parents. That's a result, lose their life savings. That's a result of the financial crisis 2020. And you notice that, like, we're noticing that traders are doing this more for, like to manage their own money. So, like, with that being said, when you manage your own money, right, you have to realize that everything has a time horizon associated with it,
Yeah.
right? And everything has a portfolio size associated with it, right? So time horizon and portfolio size, you should be building systems specifically for that. And I tell my intraday traders this all the time. I'm like, listen, you find the edge and then you build the risk profile for that edge. And then you don't look at anything else in the market. You just hit the compounding phase and you enjoy that compounding phase. And it's not like you're trying to do, once you hit the compounding phases of your intraday trading, you're not going to go reset and do more, like go back steps in intraday trading. You need to figure out what to do with that capital to push it out of the intraday trading and push it to physical assets like real estate or gold or, physical, or like in this case, like invest in equities for a longer term time horizon and spread that out, right? And so like economists are for big investment banks, right? And basically, without getting in trouble, because I'm already in trouble with my work, I read all the research from these investment banks. Like every single day, I read articles upon articles upon articles. And like, let's just say like that economic data is for specifically high worth individuals for inventory. Inventory advertisement is what I'll call it. Like it's advertisement for inventory that needs to be consumed. For us as traders, right? We're not in the, because listen, like when you open the Wells mouth and you're worth a lot of money and you're in a, whatever size element you are, you get an annual percentage just to maintain inventory, right? So let's use the QQQs for example, right? Like if I'm a big fund and I sit there and hold, well, let's say Apple, for example. Apple, right? Let's say I swallow up 100,000 shares of Apple, right? Apple will pay me an annual percentage to just maintain that stock and not flip flopping and trade it and blah, 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 just to hold it, right? So it's like anywhere between 1% and 2%, right? And that's on top of whatever yield Apple gives you that year. So that's, if you're a billionaire, that's 1% to 2% free that you get just to put something in your portfolio, right? So you got to realize like your time horizon and what style of trader, and that's what the economic news is there for, right? And to allow these big institutions to hedge with other assets and all that, right? For us, the traders that are between intraday, where you're in positions for hours, or all the way to 30 days, like all of that is noise. And you need to build systems like Andreas does because he trades equities. You need to build systems like I do because I trade intraday futures, right? That complement you being able to read the tape the easiest, right? But yeah, that's why I had with that.
Yeah.
Honestly, I think economic news is just inventory advertisement for big funds.
Yes, 100%. I agree. And let me just add that it just sells better. It sells much better if you tell your clients, okay, my GDP projection and my inflation projection is telling you that and that, and it's gonna, in the next 3 months, this and that is going to happen. It just sells perfectly good, and people go for it. My pitch is, just look at their internals. And just look at price behavior of the market, because the market is going to front run economic data is very hard to believe. And it sells very badly, but that's what my backtest shows.
Yep.
And so, I mean, investment bankers are salesmen. They want to have your AUM, and they have to have a pitch that, that sells good. And that's the reason why they do it. And I think, I'm not sure if you were, but somebody telling me in the, in the bank space, working in the bank space, he basically told me, okay, we have all that macro analysis because we get the customers, and then we use the internals to manage the portfolio. So the sell pitch is a different one. They basically use also, network momentum and, see whether the market is growthy or more in the deflationary space to manage the portfolio, but they sell to get AUM via the, the macro data. And so it's, and if you look at Druckmiller, for example, it's very hard to find, but he's looking at liquidity and market internals. Boom, that's it. That's all what he's looking at. And that's what we're doing, basically. Right.
And you notice that a lot of these individuals are looking at just that, right? Market internals and liquidity. Market internals and liquidity.
Yeah. Liquidity a little bit more for investors, right? But market internals definitely for traders. I mean, look, the market's smart. Don't try to outsmart the market. It's yes, I will be whipsawed, whatever. I was warning here, right? And then I was long here for a day, and I had to reshort, and I took your analyze to get short here. I lifted the short here. That was basically perfect timing by you. And obviously I had to pay a little bit for the hedge here, but I catch the big trend, right? Went long here, warrant here, went long here again. Yes. The hedge will be underwater from time to time. And on average, I would say they cost me money, right? But I'm a chicken. I don't want to have too much volatility in the.
Well, you also trade $1 million account, right? Like it's dumb to not have insurance when things are iffy, right? So you pay for insurance for that reason specifically.
Yes, a sub 1 million account. That's also my blog is basically called. Yeah. That's it. And I think we had a great journey together, and it took us a long time. I mean, I couldn't believe it when I saw the backtest that most economic data is not, trajectory for the market, but it's the market internals.
Well, I mean, if you think about how we did this, he's back on. If you think about how we did this, right? Like we leveraged skill sets through our lives to say, fool me once, shame on you. Fool me twice, shame on me, right? We have diverse skill sets in calling out bullshit, right? And so that's what got us to say, you know what? These guys are trash. I might not be as intelligent as them. I might not have a fancy degree, but I do know statistics. And for me, I do have a master's in statistics. And it's like something's not adding up, right? And that's why I encourage everybody who's out there trying to run their own capital to really sit there and, build your systems. And don't just glorify people because they're on, Bloomberg or CNBC. Like, call a spade a spade. If it seems and if it walks like a duck, sounds like a duck, more than likely it's a duck. If you think somebody's full of shit or their systems are full of shit, go do your research and, build a better system that because at the end of the day, it's for the individual, to manage their money and whatever their risk tolerance is, like that's what it has to be built around, right?
Yeah,
Thanks for
I mean,
coming on,
I shut down every microservice last year, and I still remember it. I think it was in December last year where I found so many economists telling me that this rally, that November rally, that basically goes on day with some drawdowns, but they were still saying there's going to be a recession and there's going to be, you were going to be, and doom sells perfectly. Doom sells absolutely perfectly. A bad message, and that's the last thing. I'm sorry for the rant, but
no.
I'd say
need to hear this.
Bad news sells so well, and they're selling their clickbaits, and that was really the situation where I said, okay. The thing is, the problem is I'm really interested in that stuff. It fascinates me, right? And I still, I still follow some of those. Lynn Alden, for example, is very good, I think, very good macro. And Michael Hall from Crossbar Capital, because they have they're looking at liquidity, so I like them. But, in November, December, when we had that monster rally, my portfolio was up 45% from November to end of December, and I still saw those guys telling me there's a recession. I just said, okay, you have to shut them down. And the other thing, I shut down every macro guy for my Twitter, and I only follow people that follow price.
Yeah, and that's key right there. Is like
it's hard to do. Because I'm really interested in that stuff, but it just doesn't work. Yeah.
But listen, like I'm with you, right? Like I find that stuff truly fascinating. I do think there's a time and place for it. But when it comes to the recession talk, guess what? Like it'll be obvious. It will be obvious. It's always been obvious. It's always been front running. And us as traders, we have the advantage, right? Maybe me, not so much you, but like I had the advantage to get in a position and out of a position within a day, right? I can shut my whole portfolio down and it'll take 2 days max, right? You may be a little bit more because you have a lot more assets than I do, but right, we don't have the concern of, needing to, sorry, I'm doing this too. Like, so our systems will pick up on that recession. And, we're going to take a loss, a small loss, but overall, like, it'll be okay, right? Our systems will be able to pick it up. And, like, when that time comes, the tape will tell us that we're definitely in a recession. But until that, like, I have no need to try to front run things because it's a losing game and it's a very expensive game.
Yeah, one last thing. I'm on one block here, and one last thing I really want to get across. I'm a super bull on the United States. I'm the only one who's using the Twitter handle Secular Bull Market USA. I started to Twitter out in 2018. So if you search for the Twitter handle Secular Bull Market USA, you will see the first stuff I put out in 2018. Then I wrote in May 2023, wrote that blog post here. I think the US is in a great place. I'm a long-term bull of the US. I put out all the reasons in here. And the same thing, I see 100% the opposite on the news. I mean, even in Germany, if you read the magazines, everybody's telling you, the US is in a bad place. That's just not the case. One last thing, I think you have to be in assets, in good quality stocks, and you're for one okay. You need to be in a little bit in gold, and you need to be in quality real estate, because my long-term macro outlook is really, and it complies with Lynn Alvin and Michael Howell from Cross-Border Capital, that inflation is going to be a problem, and you have to be in those assets to offset that. So
Yeah.
I'm a long term goal, but I think you have to be in stocks. You have to in quality stocks. You have to be a little bit in gold, and you have to be in real estate. Otherwise, inflation is running you over. U.S. is running 6% deficits. You know, I hate bonds right now. Here, I would not touch them, and that's my last.
Yeah, and I would say I would agree with that. And, you know, like, people really don't know what the $9 trillion injected in the U.S. really did to the economy. But I will say you have to pay attention to these funding liquidities. I'd rather pay attention, these funding companies, right? Like, I pay attention to China. Now, I know you do as well, but, like, companies like BABA, JD, EV companies like XPEV, NIO, right? The Taiwan Semiconductors, TMSC, right? Right? Like, believe it or not, right? Those are our Apples, those are our Teslas, those are our signs of strength. That's for China, right? And if China is a main function of liquidity for the world, funding liquidity, why would I not be paying attention to their growth stocks to see if, like, just like you do with your market regiments, just like Japan, we know Japan is the credit system of the world, right? That is a country that, and we know that they provide funding liquidity. I'm paying attention to their bond market versus their currency, right? Is that still supporting a debt-based society, right? Are they still, and like everything right now more than ever is pointing towards, we got the green light to go, to continue doing what we've been doing. But like I said, it's a big game, and I think we're going to start seeing this more as the boomers start, like, relieving some of their assets, right? I think we're going to see more doom and gloom come across, because remember what I told you, like, it's all inventory advertisement. Right?
I love that.
That's what we're going to call
love that inventory. We got some inventory. We have, actually we were bearish, but we got to get rid of it. So
yeah, exactly. All right, so I've got the highest probable levels right here, Costa. I just need your help a little bit because this new dashboard is confusing me. So, right now I needed to say, so real quick for the viewers, we put our time-based probabilities on midnight Globex settlement. Remember, settlement comes from the actual CME website, not what you see on TradingView. This is your RTH gap probabilities by 100% of the settlement, 75% off of the settlement, 50, 25, and this will change until 9:30. So make sure you remember to put this up and down based off of where price is going to be. Right? You have your structure-based probability. So the last 12 hours, whatever the probability, the highest high and the lowest low, we put the probabilities of that. Structure stat 1, structure stat 2, and then the projection-based probabilities, right? Which is saying that Asia went short to be a false and then broke, and London is currently short and true. And then so right now we need to build the scenarios. Scenario 1 is London cannot breach or cannot breach London high by 8:30. And if that's the case, 9:30 to 10:30 will be above London low. And I need the probabilities for that. Engulf.
20.
What is it?
Yeah, above London low is 26%.
All right, engulf.
Engulf is 27%.
And then below London's high?
47%.
And then scenario 2, and then with the 10:30 on bias?
10:30 on is 52% long.
Which supports healthy close today, higher than the open. Scenario 2 is London high is breached by 8:30, 9:30 to 10:30.
So both.
Above. Yeah, so this should be false.
Yeah. Let me just do that filter.
Make sure you put that Asia was broken.
Yeah, I'm doing that now. So
The part that's confusing me. So after this, how do you need to jump?
So-
Low.
yeah, I'm going as quick as I
Very
can.
good.
Asia broken between. So actually, for it to breach, so we're talking about,
It should be.
yeah, Asia mid broken is yeah. Okay, I'm good. I just need the London break now is between.
Oh, you actually put it in the time. I just put broken.
Yeah. So
You-
9:30,
You guys hear me?
10:30.
Like somebody asked me, let me check my audio.
It's very choppy, the sound.
Can you guys hear me?
Cutting out, Mickey. It's.
Uh-oh.
But I
Okay, so Discord is saying they can hear me, so it's definitely Restream.
Yes, so that means London has got a break.
Cool.
So London mid broken and
No, not. Oh, yeah, I guess you would have to put London mid broken. All right, by 8:30. Okay.
Yeah. By 8:30, yeah. And then
Thanks, Chris.
the London model break-in can be any time up to 10:30. So you 9:30, right?
I always put in it by 8:30, but yeah, that's fine.
So,
Right. Okay, that's fine.
Can you guys hear Toast on YouTube? Or is it just my audio? Whenever you want to send the probabilities, because I'm about to cut it anyway.
Yeah, and with London's true or false,
True,
right?
in this scenario, it would be false. London should be false.
Yeah. Right. Okay. Oh, not now.
All right, while you work on that, I'm going to put my OU lines on. Right, so remember these OUs, Asia OU, London OU, right, is for us to determine what probabilities the markets are going with.
Okay, I think I'm ready, and I've narrowed it down a little bit, Mickey, just to keep it simple for a moment, because I think there might be a misunderstanding. So what I've got is London short false. I'm not putting in a break of London
That's fine.
model yet, unless you want that now, because if we've gone false, we'd have to come back down
Exactly. So we
to
should
have scenario 2.
in London mid break until after 8:30, but for now it should just be London false.
Okay, so just now it's false. The probabilities are above London lows of 42%.
All right. False.
Engulfing is 37%.
All right. Below London high.
20.
And then 10:30 on.
50% long.
All right. So now what this means, these are the two scenarios. Right here, London cannot breach London high between 3 and 4 right there. Scenario 2 is this high is breached by 8:30, right? These are the probabilities. So remember, we put these midlines on to alert us, right, that probability is in play, right? So once we cross over this London midline, we can expect that this London high will be broken, which will shift our thinking into scenario 2, right? So now we have the highest probable. Oh, we got to go to distros, and then we'll be done.
Mm-hmm.
All right. So if we look right here, the average weekly range over the last 8 weeks is 834 handles. We currently are at 605. So there's still about 25% of the range left to be had, right, which is supported to the upside. Our average 10-day range is 304. We've only put in 37% of that. average 10-day range, 304. And right, like, so if we look, and we look at the data, this is the highest probable high day zone with time. Let me fix this to 14, not 2. And this is the highest probable low day with zone in time, right? So now we're going to put the rest of our distribution in. So from 4 to 8, the average distribution, and this needs to go to the 5-minute chart. Right, we can see right here is 0.42. And that's from 4 to 8 o'clock.
Yeah.
We have 8 to 12.
1.3
1.3.
or 1.29. But yeah.
8 to 12.
0.83.
And then Friday, 12 to, he said 0.83. And then from 12.
Is 0.83. 12 till 4.
12 till 1600. There's only 1 4 o'clock.
60.
All right, so now let's put this in play. Let's turn this off. All right, so this is from 4 to 8 right here, and this will be moving. Right there.
Same.
Should be from 8 to 12. And then this will be like from 12. And then this is from 12 to 16. So now that's your highest probable charts right there. Now, one last thing we're going to do is we're going to put on a premium kill zone and pivot by TFO. Right? We're going to go to the hourly chart. We're going to hide Rollins. And what this does is it allows you to say, hey, the low of the week was put on Monday. Right? So we're going to go into the settings. Right? And during the low of the week, we're going to put, what do we say, Tuesday? Monday at 1800. So low of the week on Monday. Right? And then we want to have that selected. And then we want to go to the daily and put that on. So these right now are the historical weekly profiles. Actually, let me check. So these are the daily profiles historically. Like, so before we look at that, which has a pretty good table, we go to the weekly profiles with the low of the week on Monday. And what we can see is that this blue line right here is the most supportive of what price has done, and it ends the day higher, and that happened on 6/25/2023, right? So that supports what we have currently done if you look at the blue line, or we can just put closer profiles, so take one off, take another one off, take another one off, and you can see that it is the closest profile out of all the profiles, and you can look over thousands of profiles, that this is the one that supports the current weekly profile that we're in, the week of 6/25/23, and that ends the day higher, right? So that's pretty cool. This shows that the high of the week is on Friday, 100%, Monday. Average time, high of the week happened at 10, right? For this week, that the high of the week happened at 10 o'clock, which is very interesting. So that means at 10 o'clock, it made the high and then went into a consolidation for the rest of that Friday. It shows that the average weekly range during this high probable Monte Carlos is what I call it, was 3.27, and we're currently at 3.04, right? And then you can do this.
It's quite funny. Sorry, I just wanted to add something, if I may. Just actually at that point in our modelers, it potentially is showing something similar.
Exactly, our model lines up with it. Perfect, right?
Yeah, I can't say perfect, but it's there or thereabouts. Yeah.
You bite your right?
Okay.
I'm just kidding. So now we're doing the same thing with the daily, right? And this daily, which I think he updated it, is synchronized with the moving average, and it's synchronized with standard deviations, right? So now we can see that there's two possible scenarios that plays out, right? And this is what our charts show us, right? If that London becomes a false, we can expect a lower two, right? Or we come down, take out previous day low, and then suck back into the range, or we suck in, find rejection off of Asia, and then displace down, right? Or we turn around right now and we just do momentum up, right? So going back to, so that's confirming that. Going back to our daily highest probable levels, right? Turn the drawings back on, right? We've got this OU line, this London OU line, which will confirm what we just looked at, right? So we're looking at this London OU, and then right now this is the highest probable that we continue going down. We established the low of the day, which we talked about during the NFP Friday previous month in the weekly chart, et cetera, et cetera. And then that's statistically for this scenario between 9:30 and 11:30, right? We're expecting that to happen, and then for us to make a recovery and then sit there and shop around for the rest of the day. All right, so with that being said, we're going to end the show, and I just missed my damn trade. All right, sounds good. All right, any questions from the audience? What makes OU lines? Okay, so my OU lines are, we right now, and this is going to change in the future because we just got new data. Right now, we're using 1930 to 2030 to be the range, and then what price does in relationship until 2, and then 3 to 4 is the range for London, and then all the way to 8:30. So whatever the midline of that range, 3 to 4 is making it my OU line, right? My over-under line, if we're above it, is shifting the probabilities to scenario 1 over scenario 2, and vice versa. But we just got new data that said, hey, guess what? These might not be the best times of the day from statistics to use for the range. It might be all set to the left or the right a little bit. But we'll pull in the data from that and making sure it's legit. All right, with that being said, Andreas, man, thank you so much for coming on, and I want to have you on every Friday or Monday.
Mickey, thank you.
Go through what
you guys.
Yeah, whatever you're seeing from a market approach from the industry groups and sub-industry groups, I would like to have you on to go over that.
Yeah.
All right, later, guys.